Hey, this is Mark Buffington. I was asked a question about what are some of the tax considerations when one is considering investing in a private fund. And so happy to share at least how I think about it and how, I manage my own portfolio. So whenever possible, if we have high yield, private credit funds, I don't necessarily mean high yield in the traditional sense where they're highly risky bonds, but senior secured private credit funds that are yielding double digit returns, I try to put those more certain returns into my retirement accounts or my tax deferred accounts or a pension that shields that accumulation through time, and you don't pay it. The tax on that appreciation is deferred until some future date when you take it out of that particular vehicle, a pension or an IRA or a Roth IRA, et cetera, or not a Roth IRA because you already paid the taxes. And then when I think about private equity investing, same general logic applies. If I'm nearly certain or we've gotten a unique opportunity to invest in something, I think it's going to be a big gain. I'd like to protect those gains. I will put them in a tax deferred account if I can. But I think it's important to consider in many cases in the United States, there's something called QSBS. So if you take a qualified venture and you make it an investment and you hold it long enough, in many cases, you don't pay federal taxes on that. So that's one of the ways the government incentivizes risk-taking and investing in various venture companies. And then the second point of that is if you actually lose money, which is much more common in venture, despite really good managers, even the best managers only win 60-ish% of the time, you will have write-offs in those funds, and particularly if you're investing in single-purpose vehicles as opposed to diversified funds. And when you do that, interestingly enough, those are write-offs. And the way I think about it is if you do a whole series of those individually and you're good at it, but you have certain write-offs here and there, Uncle Sam actually finances a piece of those losses because you write them off in your taxes. The IRS probably wouldn't like me saying it like that, but that's effectively what happens. So I like to take more risk in my taxable accounts, and then I'd like more certainty and like to shield those gains and more near certain gains, particularly higher yielding ones in my tax deferred accounts. So I hope that helps.